What if I told you that the biggest threat to your investments right now isn't a market crash, a recession, or even inflation, but something far more subtle and far more dangerous? It's the quiet confidence that everything will just work out. Because that's exactly where most investors are today. They've seen markets recover before. They've watched dips turn into buying opportunities. They've been rewarded for staying invested, for trusting the system, for believing that over time, stocks go up. And slowly, without even realizing it, that belief has turned into certainty. But markets don't operate on certainty. They operate on cycles. And cycles don't repeat when everyone is prepared for them. They shift. They adapt, they catch people off guard. Right now, we're in one of those moments where the majority feels comfortable. Portfolios look stable, index funds feel safe, big-name stocks feel untouchable. There's this underlying assumption that even if things go wrong, they won't go that wrong. And that's exactly the kind of thinking that creates vulnerability. Because the real risk isn't when people are scared. Fear makes you cautious. Fear makes you question your decisions. Fear forces you to think. The real risk is when people stop questioning altogether, when they start believing that past performance guarantees future results, when they start ignoring valuation, risk, and fundamentals, when investing becomes passive, not just in strategy, but in mindset. That's when markets tend to do something unexpected, not necessarily dramatic overnight crashes, but slow, grinding shifts that quietly erode wealth while people are too comfortable to react. And here's the uncomfortable truth. Most investors won't see it coming, not because the signs aren't there, but because they're not looking for them. They're anchored to what has worked before. They're relying on strategies built in a completely different environment, and they're assuming that the same playbook will deliver the same results. But what if it doesn't? What if the rules are already changing? What if the conditions that made investing feel easy over the past decade are no longer in place? That's the unthinkable part. It's not just about markets going down. It's about the possibility that the entire investing environment is shifting in a way that most people are not prepared for. And when that happens, the gap between those who are aware and those who are complacent widens very quickly. So before you think about what to buy next, or when the next rally will come, there's a more important question to ask yourself. Are you investing based on understanding or assumption? Because in times like these, that difference can define everything. For years, investors have been told a simple, comforting idea: stay invested, be patient, and the market will reward you. And to be fair, that belief hasn't come from nowhere. If you zoom out and look at broad indices like the S&P 500, the long-term trend does point upward. But the problem is not the statement itself, it's how people interpret it. Because stocks go up in the long run has quietly turned into stocks will grow consistently, predictably, and without long periods of pain. And that's where the illusion begins. The reality is far less comfortable. Markets don't move in straight lines. They move in cycles, periods of growth followed by periods of stagnation, sometimes even decline. And those stagnant periods can last far longer than most investors are mentally or financially prepared for. There have been entire decades where returns were flat after adjusting for inflation. Investors who entered at the wrong time didn't just experience temporary losses. They experienced years of waiting just to break even. Now think about that in practical terms. Imagine consistently investing, staying disciplined, doing everything right, and still seeing little to no real progress for years. That's not a failure of investing. That's the reality of market cycles. But most people don't prepare for that scenario. Instead, they anchor their expectations to recent history, where dips were short-lived, recoveries were quick, and patience was almost always rewarded within a reasonable time frame. That environment shapes behavior. It creates a generation of investors who are comfortable with risk, but only the kind of risk that recovers quickly. It builds confidence, but not resilience. And that distinction matters, because when markets enter a different phase, one that is slower, more uncertain, more drawn out, it doesn't just test your portfolio, it tests your psychology. Suddenly, the same strategy that felt safe starts to feel questionable. The same investments that seemed reliable begin to underperform. And the biggest challenge is no longer knowing what to do, but having the patience to stick with a plan when results are not immediate. This is where many investors make their biggest mistakes. Not at the peak, not during the initial drop, but during the long, uneventful middle when nothing seems to be working. They start chasing trends. They abandon long-term strategies for short-term relief. They move in and out of positions, trying to outsmart a system that rewards consistency more than reaction. And all of this happens because of one flawed expectation, that markets should always be progressing. But markets don't owe us progress on our timeline. They don't care when you started investing. They don't adjust to your financial goals, and they certainly don't guarantee smooth returns. Once you understand that, everything changes. You stop viewing volatility as a problem and start seeing it as a feature. You recognize that periods of stagnation are not anomalies. They are part of the structure of investing. And most importantly, you begin to shift your focus away from short-term performance and toward long-term positioning. Because success in investing isn't about avoiding difficult periods. It's about being one of the few who are prepared to endure them. For a long time, investing felt easy, not simple, but predictable. You could buy into broad markets, hold on through short-term dips, and more often than not, you were rewarded. That wasn't just luck. It was the result of a very specific environment, one defined by low interest rates, abundant liquidity, and strong support from institutions like the Federal Reserve. Money was cheap, borrowing was easy, and when money is easy, it flows into businesses, into innovation, and very often into the stock market. That environment created a powerful tailwind. Companies could raise capital effortlessly. Growth was prioritized over profitability. Valuations expanded because future earnings were discounted at very low rates, and investors became comfortable paying a premium for potential, not just performance. But here's the part that many people underestimate. That environment was never permanent. Now, we're transitioning into something very different. Interest rates are no longer near zero. Central banks are more cautious about injecting liquidity. And suddenly, the cost of money matters again. That one shift changes everything. Because when money becomes expensive, decisions become stricter. Companies can't rely on endless funding. Investors can't justify high valuations without real earnings, and risk starts to feel real again. This is where the unthinkable begins to take shape, not as a sudden crash, but as a structural shift. The rules that drove returns over the past decade are no longer as effective. Think about it. If you built your entire investing strategy during a period of easy growth, how does that strategy perform in a slower, tighter environment? If your portfolio is heavily tilted toward high-growth companies that depend on cheap capital, what happens when that capital dries up? If your expectations are based on rapid recoveries, how do you respond to prolonged uncertainty? These aren't hypothetical questions. They're the kind of realities investors are starting to face. And this is where the market becomes selective. Not everything rises together anymore. Companies with strong cash flow, sustainable business models, and pricing power start to separate from those that relied purely on momentum. Fundamentals begin to matter more than narratives. At the same time, speculative behavior, whether it's chasing trends, over-leveraging, or investing without understanding, gets exposed much faster. And here's the uncomfortable part. This phase doesn't feel dramatic. There's no single moment where everything collapses. Instead, it feels slow, uneven, sometimes even boring. Markets move sideways. Gains are inconsistent. Certain sectors underperform for extended periods. And overall, it feels like progress has stalled. That's what makes it so difficult. Because it doesn't trigger urgency. It drains patience. And patience is something most investors haven't had to truly exercise in recent years. This kind of environment quietly filters people out. Those who rely on excitement lose interest. Those who depend on constant gains become frustrated. And those without a clear strategy begin to drift. But for disciplined investors, this is where the real shift happens. Because when conditions tighten, noise fades. And what's left behind are opportunities that are based on value, not hype. So the unthinkable isn't just that markets might struggle, it's that the entire game is changing, from one driven by momentum to one driven by fundamentals. And if you're not adjusting to that shift, you're not just standing still, you're falling behind. At this point, the question isn't whether markets will become more challenging, it's what you're going to do about it. Because when uncertainty rises, most people default to one of two extremes. They either panic and pull out, or they ignore everything and hope for the best. And neither of those responses is a strategy. Preparation is. A smarter approach starts with accepting that you don't need to predict the market to succeed in it. You don't need perfect timing, and you definitely don't need to react to every headline. What you need is a system that can hold up under different conditions, especially the uncomfortable ones. And that begins with understanding what you actually own. If you're investing in individual companies, you should be able to explain, clearly and simply, how they make money, what drives their growth, and what risks they face. If that feels unclear, that's a signal. Because in a tougher environment, weak businesses don't just underperform, they get exposed. If you're investing through broader vehicles like an exchange-traded fund, then it's about knowing what that fund is concentrated in. Not all diversification is equal. Some funds look broad on the surface, but are heavily weighted toward a few sectors or themes. In a shifting market, those concentrations matter more than ever. The next piece is liquidity. Cash often gets dismissed because it doesn't generate high returns. But in uncertain markets, cash gives you something far more valuable: flexibility. It allows you to act when opportunities arise, instead of being forced to watch from the sidelines. Because opportunities do come, but rarely when you feel comfortable. They show up during dips that feel unsettling, during corrections that make headlines, during moments when sentiment is low. And if all your capital is already tied up, you don't get to take advantage of them. That's why preparation isn't just about defense. It's also about positioning yourself to move when it counts. Then there's the part most people underestimate: behavior. Markets are as much psychological as they are financial, and in periods of uncertainty, your emotions will try to override your logic. You'll feel the urge to sell when prices fall and chase when they rise. You'll question your strategy not because it's wrong, but because it's being tested. That's normal. But reacting impulsively is where long-term damage happens. So instead of trying to eliminate emotion, which isn't realistic, you build systems around it. You decide in advance how much risk you're comfortable with. You set rules for when you'll rebalance or invest more. You create a structure that reduces the need for constant decision-making. Because discipline isn't about willpower in the moment. It's about planning before the moment arrives. And finally, you shift your mindset. You stop viewing uncertainty as something to avoid and start seeing it as part of the process. Because the periods that feel the hardest are often the ones that shape the strongest outcomes, if you navigate them correctly. This doesn't mean being overly optimistic. It means being realistic, prepared, and intentional. Because when markets eventually stabilize, and they will, the biggest gains often go to those who stayed consistent when it wasn't easy, who kept their strategy intact when others abandoned theirs, and who were ready to act when others hesitated. So this isn't about predicting what happens next. It's about making sure that whatever happens next, you're in a position to handle it.